can't tell if you guys can actually hear that rain, but the hurricane is passing me over, so I apologize in advance if there's some background noise. But anyways, the employment situation for June was released last week, and for the most part, more of the same. Non-farm payroll grew by 206,000 jobs, which is in line with the 12-month average of 220,000 job additions each month. And that brings the unemployment rate to 4.1%, or the equivalent of 6.8 million unemployed people. Now, although unemployment has inched higher and the amount of jobs added was less than May, the changes aren't large enough to confidently say there's a meaningful month-to-month shift in the job market, in either direction. But it's still good to review these reports, because in aggregate, over extended periods of time, we start to see statistically significant trends. The big question is always, where are the jobs? Well, let's check it out by sector. The major winners were healthcare and social services, adding 82,000 positions, government adding 70,000, and construction with 27,000 additions. Industries that contracted were manufacturing, retail, and business services. Something that wasn't really on my radar, which I think is interesting, is what's happening in the temp help services sector. These are temp agencies and other orgs that broker that type of labor. If you look at the last few months, they are bleeding jobs. And I'm not completely sure why, but it's gotta be related to companies tightening their labor costs post-COVID recovery. Or maybe we're seeing a permanent shift in how businesses source their labor. Couple other things to note are part-time work for both economic and non-economic reasons is down by over 500,000 workers, and wages have gone up, just not by very much. But that's all right, because month-to-month changes in pay are expected to be small. So what's the general consensus amongst the media and major stakeholders like the Fed? The job market, along with other data coming in from GDP, inflation reports, and surveys, supports the prospect of a rate cut in September. From that perspective, this latest jobs report, specifically the unemployment rate, indicates the job market is bending, but not breaking. Inflation has moderated to a degree, the stock market has been hitting all-time highs, and although economic growth is slowing, it's still positive. So in other words, we're in the Goldilocks area. Or in other words, a soft landing may have been achieved. The focal point is here, the steadily upward trend in the unemployment rate going back to January. As I said earlier, the move from 4% to 4.1% may be small, but the move from 3.7% in January to 4.1% is something to watch. And as some people have pointed out, a 4.1% unemployment rate hasn't been hit since 2021. That's partly why people are betting on a rate cut in September. If the trend in unemployment continues to go up over July, over August, can we objectively say the job market is still strong? Well, it depends on where unemployment is at the end of that period. The historical average unemployment rate is 5.7% over the last 75 years. So numerically speaking, there's still more room for the labor market to cool off. And it will continue to cool off at some base level as inflation continues to come down. A couple scenarios can play out. The Fed cuts rates, the job market stays steady, inflation hits their 2% target, soft landing achieved. Or the Fed cuts rates, the job market resolidifies, inflation returns, progress undone. Or the Fed keeps rates high, the job market continues to decline, inflation hits their 2% target, but are we looking at a recession? And every scenario in between is quite frankly possible. My point is, whether you think rates need to be cut or not depends on your interpretation of historical data that tends to lag market dynamics. And if you're forward-looking, the future rarely plays out the way we predict. It's all imprecise science to some degree. And I'll tell you what, I don't envy the Fed's job whatsoever. It's more likely they overshoot or undershoot than getting this thing perfect. This week's CPI inflation report is huge because although the Fed prefers to use PCE to gauge inflation, the CPI is an early indicator of the rate of change PCE will showcase. If there's more improvement in CPI over the previous period, PCE will likely follow suit. But generally speaking, if CPI comes in under expectations, that adds to the likelihood of rate cuts later this year. Now, if CPI decides to shock us all and actually shows inflation has either stagnated or even risen, then it wouldn't surprise me at all if the Fed took rate cuts off the table completely for 2024, assuming there's no catastrophic event in the economy. So yeah, big report this week. The last thing I'll say before wrapping up is to remember that this is all national level data built on an imperfect method of collection. A lot of surveys, a lot of voluntary responses, and therefore preliminary mistakes. So if any of this analysis fails to represent your current individual situation, it's not saying your experience is invalid. On the contrary, your differing experience speaks to how we could all be struggling at the margins despite being told the economy is just fine. At least from my perspective, speaking for myself, you are completely heard. Let's leave it there, y'all. The jobs report for June. What do you think of it? Positive or negative economic signal? Did it hurt or improve the chances of lower interest rates? If you got something out of this video, consider liking and subscribing for more. If you have any questions, you can leave those in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.